Hello, it's Greg Gornick, Vice President, Senior Investment Advisor of Canaccord Wealth Management and Gornick Wealth Management. I'm so happy you can join us today where we try to make sense of the markets. It has once again been a wild couple of months since the last time we've had Martin Roberge join us, our Senior North American Market Strategist, to make a little bit of sense with what's going on in the markets right now. Hope we can help you out. I'm going to turn it over and we're going to talk to Martin Roberge right now. Good morning, Martin.
Good morning.
So it has been, I hate saying unprecedented because it seems that's what I do all the time. I mean, there's so much has happened since the last time you and I got together on the podcast. Since March, we've seen a decline in the markets of over 32%. We've seen a recovery, and now we've seen the Fed just aggressively move into the marketplace right now. And I just wanted to talk a little bit about your report that you put out, some midweek observations. How are you seeing the market right now and the bullish sentiment that you seem to be taking on?
Probably we have normalized investor sentiment to the right level. By this, I mean that probably the rally we've seen from the March low is legitimate to the extent that we're back to I would say a valuation level that, if we adjust for the level of interest rates, is giving us a fair value for both the U.S. and Canadian stock market, which is about where we are today. So again, like the surprise of the rally is the speed and the recovery. But the level where we are today makes sense. It's just that we would have thought that we would have seen those numbers later this year, and here we are in June, and we're right at our fair value and targets. So we're a bit surprised, not so much by where we are today, but by the speed of the market rally. That being said, talking to our institutional clients, most of the buying was made by those investors in April and May. They have been slowing down their purchases without selling much of what they bought earlier this year. And just to give your clients an overview or an idea of what's the rationale behind this strategy, is that they're saying, you know what, yeah, maybe the upside is becoming limited here, but I want to stay in the game. And the reason I want to stay in the game is that the Fed is basically backstopping credit risks. And as you know, the stock market is full of companies like the S&P is 500 companies of investment grades. And if the corporate bond prices are not moving down because the Fed is backstopping the risk by providing various backstops, well, it's nearly impossible to see equity prices weakening while credit prices or corporate bond prices are strengthening on the back of the Fed's actions. So, Greg, like it might sound bizarre the way I say it, but it's not so much the upside potential that is driving investors into the market, but the fact that there's not much downside risks as long as the Fed is around. And as you know, most of the financial backstops that have been announced over the past month will not expire before the fall. Just the PPP in the U.S., like the Paycheck Protection Plan, like it has been extended until the U.S. election. So you're going to continue to see a recovery in the jobs market and a gradual recovery of the economy. So the momentum is clearly to the upside. So the quantity of growth is not going to be that much, but the direction of growth is obviously positive. And again, like I kind of repeat myself, but investors want to stay in the game or stay in the market because they want to be exposed to those economic green shoots. They want to be exposed to potentially a new vaccine, okay? And want to stay exposed to potentially further stimulus from not only the Fed, but other central banks. we've seen this week the Bank of England adding more to their QE. Bank of Japan as well, a little bit more. So as long as central banks are adding to their balance sheets and adding more liquidity, investors are basically staying put and understanding that yes, there will be corrections. Actually, we had one last week, but those will probably be gut check corrections.
Now, let's talk a little bit about money markets and their cash balances right now, because you made a couple of good points about that in your notes this week. How do you see cash balances piling up, and how that fits with your bullish sentiment, where we're almost at the extreme TINA trade? There is no alternative. It's a crazy way to think of the world, because it feels like we need to almost abandon all rationale and just jump into the markets because the Fed is saying jump into the markets, which is, in my experience, an odd way to take it. But why don't we talk a little bit about those cash balances?
Yeah, we are at about 7 billion in Canada over the last year. 7 billion, or like 6.9, has been added to in the money market funds. That's the flow. The quantity of cash is at 37 billion overall, and that's about 17% of the market cap of the TSX, which is very high. Historically, you rarely go much higher than 15. So the cash balances, or I would say, sorry, the amount of money in money market money market mutual funds is extremely high. So this is positive to the extent that it could potentially be pent up demand for stocks. And as a segue to my note this week, we looked at the performance of the market from the bottom and how fast it's been. And historically, I don't want to get too much into the technicals, but historically, when the S&P trades so much above its 50-day moving average, it's a positive shock, because historically you get those overshoots early after a recession. So once you go through a recession, you have what we call a post-recession rally in stocks, and then stocks get really extended to the upside, and they deviate too much from their moving averages. And relative to the 50-day moving average, what we've seen lately is something that we've seen only 5 times over the last 55 years. And every single time that we had such a technical overshoot, the market went through a technical correction for about 15 days and then made new highs 1 year forward. So every time the market was up, even though like we peaked at a level where it was very, very overbought, after some consolidation and churn, the market eventually resumed its uptrend over the following year. And it is as if the signal from the magnitude of the move is so powerful that it cannot be just a bear market rally. It has to be the beginning of maybe another baby bull market. And and when you see and you look at the performance between stocks and the economy, you say, what the hell's going on? Like, the economy, okay, yeah, is better, but we're rebounding from a very soft level, and the stocks are trading as if we were back to last year in terms of GDP growth. But again, this money that has been moved to the sidelines is probably what will be redeployed going forward to feed that new baby bull market. And we looked at the short covering activity also, because as you know, people are somewhat skeptical about this rally. So a lot of speculators have been also shorting the market, and the amount of short positioning in the US and Canada are nearly at all-time highs. So all of a sudden, if those bearish speculators start to cover and buy back their short positions, this is another marginal buyer of stocks. So money on the sidelines plus short covering activities could be the fuel needed to get this baby bull market. So again, it's going to be very choppy because valuation wise, we're pretty high. But again, like when you include the dividend yields plus a little bit of capital appreciation, I think you're going to get more than what the bonds will give you. And one more point, Greg. Yes, North American equities are expensive, but international equities are not. So you're trading around 14 times emerging markets, about 16 times for EFI equities. So one way to stay in the game on a risk-adjusted way, it's to move from North America into international equities, where I believe you have a better reward to risk ratio.
Okay, now and that's a good point too. I mean, a couple of things that you pointed out. First off, that international equities are cheaper. You might want to be taking a look there. The other point that struck me this week is that to see you recommending going long on banks, because I've always known your opinion on banks for the past little bit. And what was the rationale behind that?
Yeah, first of all, this is not an outright long. It's a relative play relative to life insurance companies. So I'm still neutral on the banks. As you know, I've been extremely cautious on banks both in the U.S. and Canada. But most of the damage was done in the underperformance from the beginning of the year till May. So I said, okay, most of the bad news are discounted. I upgraded the banks last month, but I kept the life insurance companies underweight. So the trade or the recommendation is more one where I say, if you want to be in the financials, you're better off in the banks than in life goes or life insurance companies, because as you know, life insurance companies, the money they get from the premiums is reinvested in risk-free assets and mostly bonds. And as you know, bonds are very low at around like 0.75% in the US. And most of the actuarial assumptions to cover the obligations from premiums that life insurance companies must pay to their holders, premium holders, like they assume a rate of return of 3%. That's the minimum, and we're at 75 beeps or 0.75 on 10-year treasuries. Yeah. So if the Federal Reserve say we decide to implement a yield curve control, so they put a ceiling or a cap on 10-year treasuries at, let's say, 1 or 1.5, life insurance companies will need to take write down in their book value. So we saw this experience in Japan when they implemented a yield curve control in September 2016, and life insurance companies had a really bad time back then, and I expect that over the next year and a half, the next fiscal stimulus, or not fiscal stimulus, but the next monetary stimulus will probably be a yield curve control where the Fed says, okay, I'm capping 10-year treasuries maybe at 1.5. I want to make sure that the economic recovery is not derailed by higher bond yields. So I put a cap there, and this is probably the kiss of death for life insurance companies. So I'm basically recommending investors to favor banks over life goes, but within my equity portfolio, I'm neutral on the banks.
Well, that's a good point. I mean, really, I think that really sums up everything that's going on in the market right now. And I just want to say thank you for joining us again for us to all make some sense out of what's going on in the markets, because we've got a bullish trade on right now. If you've got that much money short in the markets and money on the sideline, we all know how that plays out, that is bullish in the markets. So I think we just all have to hold our nose, I guess, and make sure that we're looking for the cheapest assets we can. Once again, thank you, Martin, for joining us. Thank you very much.
My pleasure. Bye-bye.